Hello and welcome. Today, we're going to demystify the world of investing. I know it can seem super complex and maybe even a little intimidating, but my goal here is simple. By the end of this, you'll have a clear, easy-to-understand map to navigate it all. Ready? Let's jump in.
You know, when you first start thinking about investing, it's so easy to feel completely overwhelmed. You're hearing about stocks, bonds, commodities, real estate. It's just this whole universe of jargon that can make you feel lost before you even take the first step.
But what if I told you that all of that complexity, all that noise, could be boiled down to a single, fundamental question? Seriously, it's a simple framework that cuts through everything and reveals what you are really doing with your money.
And that question is this. Do you want to be an owner or a lender? That's it. Do you want to own a piece of something and share in its potential growth and profits? Or do you want to lend money to someone with the promise of being paid back with interest? Owner or lender? This is the core distinction, and it pretty much defines the two biggest categories in the entire financial world.
So, let's start with that first path, becoming an owner. This is the world of equity. It's all about taking a direct stake in the future success of a business. See, when you buy a share of a company, it's not like buying a lottery ticket. You are literally buying a tiny piece of that company. That makes you a part owner. And because you're an owner, you have a claim on its future profits and, in many cases, a voice in how the business is actually run.
Okay, so you're an owner. How do you actually make money? Well, there are two main ways. First, as the company makes profits, it might decide to share some of that cash directly with you. Those payments are called dividends. The second way is what's called capital appreciation. If the company does well and grows, your little piece of it becomes more valuable. The share price goes up and you can eventually sell it for more than you paid for it.
But it turns out not all ownership is created equal. Take a look at this. With regular equity shares, you get voting rights, you get a say. But there's another type called preference shares, where you usually give up your vote. So what do you get in return? A huge perk. When the company pays out dividends, you get your money before the regular equity shareholders. It's a classic trade-off between having control and getting priority.
All right, so let's flip the coin and move to the other side of our big question. If you're not an owner, you can be a lender. Welcome to the world of debt, or what a lot of people call fixed income.
So what is a debt instrument? Honestly, you can just think of it as a really official IOU. You lend your money to an organization, maybe a government, maybe a company, and in return you get a contract. That contract promises that they'll pay you back your original amount, plus a series of interest payments over a set period of time. It's a promise of a future stream of cash.
And who's doing all this borrowing? Well, mainly governments and large companies. Government bonds are often called gilt-edged because they're seen as the gold standard of safety. I mean, the risk of a major government not paying you back is practically zero. So, to even compete for your money, companies have to offer you a better deal, a higher interest rate or yield to reward you for taking on a little bit more risk.
And that difference in the interest rate is a really important idea in finance. It's called the credit spread. It's basically your risk premium, the extra cash you get paid for choosing a corporate bond over a super safe government bond. And it matters because if you see that spread getting wider, it can be a sign that investors are starting to get nervous about the economy as a whole.
So how do we actually measure that risk? That is where credit ratings come in. Special agencies look at the financial health of a company or government and give it a grade, almost like a report card. It goes from the super safe AAA all the way down to D, which means they've already defaulted. Anything BBB or higher is called investment grade. Anything below that is known as high yield, or sometimes, less politely, junk bonds. The risk is higher for sure, but so is the potential reward.
Okay, so far we've talked about owning paper assets, like a share in a company, or lending money through a contract, but you can also invest in things you can physically see and touch. This is the world of tangible assets.
And the most common one, of course, is real estate. You make money from it in two main ways. Either you collect a steady stream of rental income, or you sell the property for more than you paid for it down the line. And here's the really cool part. You don't need to have millions to buy an entire office building. You can invest in something called real estate investment trusts, or REITs, which are basically companies that own and manage huge portfolios of property for you.
Now, beyond buildings, there's another massive world of physical stuff called commodities. A simple way to think about them is in two buckets. You've got hard commodities, things that are mined out of the ground like gold, silver, and oil. And then you have soft commodities, which are grown, like corn, wheat, and sugar. What's so interesting is how their prices are driven by totally different things. Gold is often seen as a safe haven when the economy gets rocky, while the price of something like corn can shoot up or down based on a single weather forecast.
So we've covered stocks, we've covered bonds, and we've covered tangible assets. But there is a fourth, kind of wilder category out there: alternative investments. This is where things get a lot more specialized. And honestly, it tends to be the playground for more sophisticated and wealthy investors.
This category includes things like structured products, which are really complex, custom-built investments, or distressed securities, where you're basically buying the debt of a company that's on the brink of bankruptcy, hoping for a turnaround. Even things like fine art, rare wines, and other collectibles fit in here. The key things to remember are that these assets are often unique, hard to sell quickly, and they definitely require some very specialized knowledge.
Phew. Okay, we've just mapped out the entire universe of what you can invest in. But that brings us to the next big question. How do you actually do it? Let's talk about your personal path to investing. Broadly speaking, you have two main choices. You can go the direct route, the DIY approach, where you do your own homework, open a brokerage account, and buy individual stocks and bonds yourself. This gives you complete control. Or you can invest through a managed portfolio. This is where you pool your money together with a bunch of other investors, and a professional manager makes all the decisions for you. Now, even within those managed funds, you can think of it in different tiers. Mutual funds are built for pretty much everyone. The minimum investment is low, and they're heavily regulated to protect you. But as you move up the ladder to things like portfolio management services or PMS, and then alternative investment funds or AIFs, the minimums jump a lot. We're talking from around 50 lakhs to over a crore. These are really designed for high net worth individuals who are okay with more complex and often riskier strategies. So there you have it. We started with one simple question: owner or lender? And from there, we've mapped out the entire investment landscape. You now have a framework to understand where every single opportunity fits. The only question left is, now that you have the map, what's your first destination going to be?